Welcome back. Today, we're diving into a high-energy analysis report on the nanocap stock WOK, titled WOK Crashes 40% Alert. Is this the perfect entry?
Yeah, this one jumps right off the page. It's an oversold bounce play, pure and simple. The energy is great.
It really is. It hooks you with that massive drop. But, with these high-speed analyses, timing and structure are everything. If you bury the lead, you lose your audience.
Exactly. So let's jump right into that. Our first point is this. The crucial legal update that underpins the entire bullish thesis is currently positioned too deep in the material's structure, and it really slows the impact of the mystery angle.
Okay, so let's break down that weakness. The report does a fantastic job setting up the crash and then the mystery.
Right, the 40% drop with no news. It's a great hook.
But what's the first thing anyone thinks when a microcap stock craters like that?
Delisting. 100%. They're thinking this thing is going to zero tomorrow.
And the single most powerful fact that counters that fear, the fact that WOK has a NASDAQ extension all the way until April 2026, is saved for, what, reason number one of the bull case?
Yeah, it's buried. You're forcing the person reading this to hold on to that skepticism for the entire intro. They're thinking, why is this guy pitching a stock that's about to be delisted?
It's an unnecessary headwind. You've built all this urgency around the crash, but it's completely diluted by this unspoken fear.
The trade is basically dead on arrival if they think it's a delisting play. It just is.
Right, so the suggestion for improvement is critical here. We have to resequence that core fact. It needs to come up immediately after you introduce the 40% crash.
Immediately. You solidify that mystery angle with something credible and super specific. You have to front-load the single biggest piece of information that refutes the panic.
It's about flipping the narrative instantly. The bull case here isn't just a chart pattern. It's the fact that the market's biggest fear. It's just wrong.
I see exactly where you're going. The mystery section right now just says there was no specific news.
Which is good, but not great.
We can make it great. So for a concrete example, you could rework that mystery section to say something like, there was no specific news, no SEC filing, no bankruptcy notice to justify a 40% drop. And crucially, WOK was granted a compliance extension until April 6, 2026.
There is.
Then you add, this tells us the drop was pure, uninformed panic selling and stop-loss hunting, based on a totally incorrect assumption.
Yes! That small change reframes the entire analysis. The reader goes from, is this stock dying, to, wait, the market panicked over a non-issue?
Exactly. And that's the mindset you need to establish to sell them on the perfect entry. You've just neutralized the biggest counterargument before it even fully forms in their head. That one structural change, it makes a world of difference.
Okay, so we fixed the initial fear factor. The reader's on board. They know the company isn't being delisted tomorrow.
Right.
So now we have to make sure they survive the trade, which brings us to risk management.
Which is everything in a play like this. So, next point. While the material correctly calls this a high-risk, high-reward lotto play, the instruction to keep it brief for the bear case, it really minimizes the report's credibility.
I could not agree more. We're talking about nanocaps. This is the riskiest corner of the entire market. You can't just gloss over the downside.
No way. And the weakness is that the bear case just lists dilution danger and cash burn. Which, okay, that's accurate.
But it's not enough.
Not for a company with a market cap of, what, $66,000? That's not a company, that's a nice truck.
Right. And with these kinds of analyses, the risk has to be tied directly to the opportunity. By keeping the bear case that brief, it starts to sound a little promotional.
A little too hypey, yeah. Not speculative, but cautious, which is the tone you need for credibility here. The people reading this know how fast these things can unravel.
The nanocap space is just brutal. If you're going to highlight the explosive upside from a tiny float, you have to hit the corresponding downside just as hard. Otherwise, it just feels incomplete.
Or naive.
So the suggestion here is to integrate the risk factors directly into the most exciting part of the bull case, the nano float volatility section. You create this balanced, urgent perspective.
So the reader understands why the risk is so severe. It makes the stop loss feel like a survival tool, not just a suggestion.
Exactly. You have to explicitly connect the dots between the opportunity, a tiny float that can pop, and the risk, a tiny float that makes dilution absolutely catastrophic.
Okay, I like that. But the nanofloat section is supposed to be the most exciting part, right? It's where you predict the 50 to 100% pop. How do you bring in the risk there without just, killing the mood?
You use the immediacy of that risk to hammer home the need for discipline. So when you're talking about how one big buy order could send the $66,000 company screaming up to 15 cents.
You immediately follow it with the counterpoint.
Yes. Let's get concrete with an example. Right after you paint that bullish picture, you could add a sentence like, however, that same minuscule market cap means the dilution risk isn't just a financial term, it's an immediate execution risk.
Okay.
And then you say, even a small, unanticipated announcement of more shares could instantly annihilate the 6-cent support level, taking us toward zero, which makes that stop loss absolutely critical.
That's a huge improvement. It's so much more powerful.
It makes the risk specific. It moves it from some vague disclaimer at the end to a core part of the actual trade strategy.
And it warns the reader about what could happen to their specific entry point. The stop loss suddenly feels non-negotiable. That's what you need for a lotto play. You build so much more credibility that way.
All right, so we've fixed the structure, we've balanced the risk. Now let's get tactical, the plan for taking profits.
The part where the rubber meets the road.
And the technical setup in the report is sharp. The entry point, the stop at 5.5 cents, the first target at 9 cents, it's all very clear.
The trade plan is solid, no doubt. But I want to look closer at that ultimate upside target.
Okay.
So, third point. The technical analysis and the two-tiered trade plan are sharp, but relying solely on the gap fill target of 11 cents, it limits the analytical depth when you're defining that high-end potential.
So, as I understand it, target 1 is 9 cents and the moonshot is 12 cents. And the main technical reason for that upside is filling the gap from the crash up to 11 cents.
Exactly. And there's the weakness. The jump from 11 cents, the technical ceiling, to 12 cents for the moonshot, it feels a little disconnected.
A bit arbitrary.
Yeah. If the whole rationale is the gap fill, why are you telling me to hold past it for 1 extra penny? The report needs a stronger reason to risk giving back all those gains between 11 and 12 cents.
It feels like it's missing a connection to the earlier point about the explosive volatility, which hinted at a move to 15 cents.
Right. The whole target structure needs to be more persuasive. So the suggestion is to anchor that final moonshot target to a broader context, something more than just the immediate gap.
Something more psychological, maybe.
Exactly. That would really bolster the justification for holding past 11 cents. It ties the whole story together. Think about market memory. When a stock crashes 40% from around 13 cents down to 6 cents, the market doesn't just forget those old levels.
The points of high liquidity, you mean?
Yes, and for a violent squeeze, the most important psychological level isn't always the precise gap close. It's often the last major area of resistance right before the panic started.
Which the material did mention. The open price the day before was closer to 13 cents. That's a powerful anchor.
It is, but are we sure that's sound analysis for a nanocap? Or are we just, hoping for a short squeeze? The gap fill at 11 cents is a known technical magnet. Why risk it?
Because in this exact type of trade, an oversold bounce on a high-risk nanocap, the real money is often made beyond the standard technical points. It's driven by short covering and FOMO.
Fear of missing out.
Right. If the fundamental fear of delisting is gone and the float is microscopic, the squeeze will often overshoot that immediate ceiling. It will challenge the last point where resistance failed. That 12 to 13 cent zone is that failure point. We need to explain that.
Okay, that's fascinating. So we need to weave that psychology into the targets.
Yes. So for a concrete example, you could clarify the rationale for that final target explicitly.
How would you frame that?
Something like resistance 2 is 11 cents, the technical gap fill target. However, the moonshot target of 12 cents recognizes that a high-volume squeeze driven by short covering and new FOMO often attempts to challenge the most recent opening price, which was near 13 cents, before it gets exhausted.
I like that.
This 12-cent level provides a stronger, psychologically supported area to take final profits, and it justifies the risk of holding past the initial gap closure.
It just explains the why behind the target. It shows it's based on more than just hope.
It's grounded in the behavioral mechanics of these kinds of plays. I love it.
This has been a really strong session. We really focused in on maximizing the impact of this urgent analysis report. 3 crucial opportunities.
Yeah, 3 things that will make this WOK bounce strategy feel much more credible and disciplined. So first, the structural change. Move the NASDAQ extension date up to the very beginning. By front-loading that fact, you disarm the delisting fear, and you turn panic into a calculated opportunity.
Right. It maximizes the hook. Second, we boosted the credibility of the risk management. That means integrating the dilution danger directly into the discussion of that tiny $66,000 market cap.
You link the low valuation to the catastrophic risk, and suddenly that stop loss feels non-negotiable.
As it should be. And finally, we refine the tactical plan, providing a more robust, psychologically anchored reason for holding past 11 cents.
Connecting that 12-cent moonshot target to the stock's previous high liquidity levels just before the crash. It grounds the upside in something more than just hope.
Altogether, these revisions really transform the report from a risky tip into a disciplined, psychologically sound trade strategy.
So,